Four financial products all show the number 12%. One simple interest calculation ends at 11,200 reals. One monthly compounding calculation ends at 11,268 reals and 25 halalas. A fee can make a borrower's effective cost feel closer to 14.29%. And after 5% inflation, the exact purchasing power growth may be only about 7.32%. Same headline number, four different questions. A rate such as 12% is not a complete financial sentence until we know its period, accrual method, frequency, fees, inflation basis, product, and rules. This lesson has three mathematical axes and one disclosure layer. First, simple versus compound asks which balance earns interest. Second, quoted nominal versus effective asks how a periodic rate is expressed over one full year. Third, nominal versus real asks whether inflation has been removed. APR, APY, and AER then add product and regulatory definitions around those calculations. Before calculating anything, we will learn how to read the full identity of a rate. Start with the base. Is interest calculated on 10,000 reals, an outstanding loan balance, an average daily deposit, or something else? Then name the period. Is 12% charged per month, quoted per year, or earned over a 2-year holding period? Next, name the direction. Is the rate paid by a borrower, earned by a saver, or used as a comparison or discount rate? Finally, identify the accrual method, compounding frequency, fees, inflation basis, product type, and governing rules. The percent sign tells us the scale. It does not tell us the contract. These distinctions are independent. Simple versus compound describes the accrual method. Nominal annual versus effective annual describes how a periodic rate is quoted or summarized over 1 year. Nominal money rate versus real rate describes whether inflation has been removed. A rate can be compound, quoted nominally, and still be nominal in the inflation sense, all at the same time. The most dangerous word in this topic is nominal. A quoted nominal annual rate can mean an annual label that has not yet incorporated within year compounding. A nominal money rate can also mean a return measured before removing inflation. Those are different comparisons. Every time this video says nominal, the screen will identify which meaning is intended. First, we will compare two accrual methods by watching which balance earns interest in the next period. Begin with 10,000 reals and a 12% annual simple rate. 12% of the original principal is 1,200 reals. Under simple interest, that original 10,000 real principal remains the calculation base every year. After 1 year, the amount is 11,200. After 2 years, another 1,200 is added, producing 12,400. The interest amount grows linearly because the base does not update. Now use the same 10,000 reals and 12% annual rate, but compound annually. Year 1 is identical. The balance becomes 11,200, but year 2 calculates 12% from the new 11,200 real balance. The second year interest is 1,344, not 1,200. The ending balance is 12,544. Compound interest updates the base after every compounding event. The 12% in both examples uses the same annual scale. The difference is not the unit of the rate. The difference is the accrual method. Simple interest repeatedly measures the original principal. Compound interest repeatedly measures the updated balance. After 1 year, the paths match. As more periods pass, they separate. Next, we will decode an annual quote, derive its periodic rate, and calculate the actual 1-year compound growth. A periodic rate applies during one compounding period. A quoted nominal annual rate is an annual label connected to those periodic rates. If 12% is explicitly a quoted nominal annual rate compounded monthly, divide by 12 to obtain a 1% monthly rate. This division is valid because the input is the annual quote and 12 monthly periods are declared. If the input were already 1% per month, dividing by 12 again would be wrong. Apply the 1% monthly rate 12 times. Each month multiplies the balance by 1.01. The next month begins from the balance produced by the previous month. After 12 periods, the total growth factor is 1.126825. 10,000 reals becomes approximately 11,268 reals and 25 halalas. The effective annual rate shows the compound growth produced over a full year. 1% each month compounds to about 12.68% for the year. So the 12% quote and the 12.68% result are both correct. The quote states the nominal annual rate. The result states the effective annual rate. The conversion also works backward. If the effective annual rate is 12.6825% and the quote compounds monthly, take the 12th root of 1 plus the effective rate, subtract 1, then multiply by 12. That recovers the 12% nominal annual quote. But if 12% is already an effective annual rate, dividing it by 12 does not produce the equivalent monthly rate. The equivalent monthly rate is the 12th root of 1.12 minus 1, approximately 0.9489% per month. Hold the quoted nominal annual rate at 12% and change only the compounding frequency. Annual compounding produces 12% effective. Semi-annual produces 12.36%. Quarterly produces about 12.5509. Monthly produces 12.6825. Daily, using 365 periods, produces about 12.7475. More frequent compounding increases the effective result, but the growth approach is a limit. It does not increase without bound. Continuous compounding is a mathematical limit where growth happens in smaller and smaller time steps. With a 12% continuous annual quote, the one-year growth is about 12.75%. The formula uses the exponential function. This is a useful boundary for comparison. It does not mean a bank literally posts interest infinitely often. We will now leave pure compounding mathematics and enter regulated borrowing cost disclosure. Effective annual rate measures compound growth. A borrowing cost disclosure answers a different question under applicable rules. A loan's interest rate describes the charge applied to the borrowed balance. An annual percentage rate may also reflect defined fees, payment timing, and other included finance costs. The exact definition depends on the product and jurisdiction, so neither shortcut is safe. The disclosure rate is not automatically the quoted nominal rate, and its included fees depend on the governing rules. Always name the product and jurisdiction before comparing the number. Consider a synthetic one-year loan. The contract says 10,000 reals, but a mandatory 200 real upfront cost leaves only 9,800 of usable proceeds. 1 year later, the borrower pays 11,200. Comparing the payment with the usable proceeds gives a simple one-year cost intuition of 14.2857%. This demonstrates why a borrower's cost can exceed the stated interest rate, but this is not automatically the legally disclosed APR. A compliant APR depends on the governing rules, dates, payment schedule, included fees, assumptions, and required calculation method. Different rule books can operationalize APR differently. In U.S. closed-end consumer credit, Regulation Z prescribes methods for determining and disclosing APR, and consumer guidance explains that APR can be broader than the stated interest rate because applicable fees may be included. Under current SAMA rules, APR is defined through present value equivalence between the payments owed by the borrower and the amount of financing made available, with prescribed cash flow, timing, calculator, and disclosure requirements. The safe engineering rule is simple. Never code a universal APR formula without first naming the product and rulebook. Next, we will separate a generic effective annual calculation from regulated savings yield labels. A generic effective annual rate reports the one-year compound growth created by a periodic rate. APY and AER are normally disclosure labels for savings or investment products under prescribed assumptions. In the simple synthetic case of 1% monthly growth with all credited interest remaining in the account, the mathematical effective annual growth is 12.6825%. A regulated APY or AER may operationalize that idea, but the official definition, term, day basis, reinvestment assumption, tiering, withdrawals, and product rules still control the disclosure. Effective yield calculations depend on what happens to credited interest. If the product assumes interest remains in the account, future interest may be calculated on the higher balance. If interest must be paid out or the customer withdraws it, the realized path can differ. Tiered balances, stepped rates, minimum balances, account terms, and day count rules can also affect a regulated disclosure. Never copy an EAR number into an APY or AER field, merely because all three are annual percentages. We will now separate money growth from purchasing power growth by introducing inflation. Suppose our 1-year compound result is 12.6825%. That is a nominal money rate in the inflation sense. It measures growth in currency units before removing changes in the general price level. If consumer prices rose 5% over the same comparable period, the purchasing power gain is lower. The money balance increased, but the price of the basket also increased. Real return asks how much the balance grew after accounting for that inflation change. For an exact discrete comparison, divide the nominal growth factor by the inflation growth factor, then subtract 1. 1 plus the effective nominal rate is 1.126825. 1 plus 5% inflation is 1.05. Divide those factors and subtract 1. The exact real result is approximately 7.3167%. A common shortcut subtracts inflation from the nominal rate. 12.6825 minus 5 equals 7.6825%. That is an approximation, not the exact result. Here it is about 36.6 basis points higher than the exact real rate. The inflation input also changes the meaning. Expected inflation produces an ex ante real rate. Realized inflation produces an ex post realized real rate. And an official consumer price index measures average price change for a representative basket. It may not match one household's personal spending experience. We will now combine every distinction into one practical checklist for comparing financial products. When a product shows a rate, ask these questions in order. What amount or balance is the base? Is the rate earned, charged, or used for valuation? What period does it cover? Is it already a periodic rate, or is it an annual quote? Is the accrual simple or compound? If compound, how often? Is the annual number nominal or effective? Are fees included? Is the label APR, APY, or AER under a specific rulebook? Has inflation been removed? And are all comparisons using the same currency, period, and definition? Only after those fields are known is the rate ready for comparison. Suppose 4 cards are placed side by side. Card 1 shows 12% simple annual interest. Card 2 shows a 12% nominal annual rate compounded monthly. Card 3 shows a loan interest rate but omits the APR and mandatory fees. Card 4 shows a nominal return without inflation context. These cards cannot be ranked from the headline numbers alone. First, convert compatible mathematical rates to a common effective basis. Then, inspect fees and regulated disclosures. Then, when purchasing power matters, compare a compatible nominal result with inflation. We will now use the Fintech Builder lessons, current official disclosure sources, and the verified package implementation. On the fintechbuilder.com, begin with simple interest. Highlight the fixed original principal, the principal rate time contract, and the guided lab. Next, open compound interest. Highlight that each period earns on the amount already built, then compare its timeline with the simple interest path. Continue to return annualization and de-annualization. Highlight the monthly 1% example, the 12.68% annual result, and the warning against dividing or multiplying rates without respecting compounding. Finally, use present value and future value as the bridge into APR. The disclosure problem depends on cash flow amount and timing, not just one printed interest rate label. The Fintech Builder supplies the mathematical foundation. Regulatory labels require regulatory sources. For APRs, show current official CFPB and SAMA definitions. For APY, show the current regulation DD appendix. For AER, show the current SAMA savings rate definition. For inflation, use the official CPI explanation only to define an average consumer price measure, not to claim it matches every viewer's personal expenses. This sourcing boundary keeps mathematics, disclosure law, and personal interpretation from becoming one blurred claim. The code can reproduce these calculations. The package implements simple interest, compound interest, and annual rate conversion. The supplied implementation note targets version 0.13.0, but always verify the current registry and exported functions before recording. Run those implemented calculations, then calculate the exact real rate explicitly. The package does not supply a generic legal engine for regulated borrowing or savings labels. Those labels remain separate application and compliance responsibilities. A complete video does not require pretending that one library implements everything. Use the package where the contract exists and is verified. Use an explicit formula where the mathematics is standard but not yet packaged. Use current official rules where a disclosure is legal or product specific. That source separation is more trustworthy than one fictional all purpose interest rate function. We will finish by diagnosing the most believable wrong answers, then test the complete rate decoder. Mistake 1, treating simple and compound as different rate units. They are accrual methods. Mistake 2, dividing a rate by 12 even though it is already a monthly rate. Mistake 3, dividing an effective annual rate by 12. Use the matching root instead. Mistake 4, entering 12 in code when the calculation expects 0.12. Mistake 5, comparing a yearly rate with monthly periods without conversion. Mistake 6, rounding the monthly rate before 12-period compounding. Mistake 7, calling every annual rate an APR. Mistake 8, treating APR and EAR as universal synonyms. Mistake 9, saying APR always excludes compounding or always includes every possible fee. Mistake 10, copying an EAR into an APY or AER field without checking the product rules. Mistake 11, subtracting inflation without labeling the result as an approximation. Mistake 12, mixing expected inflation with realized inflation, or comparing nominal cash flows with a real discount rate. Final quiz. A savings product quotes a 12% nominal annual rate compounded monthly. Inflation over the same year is 5%. Question 1. What is the monthly periodic rate? Question 2. What is the mathematical effective annual rate? Question 3. What is the exact real rate using the effective nominal result? The answers are 1% per month, 12.6825% effective annually, and approximately 7.3167% real. An interest rate becomes meaningful only after its full identity is known. Simple versus compound tells us which balance earns interest. Quoted nominal versus effective tells us how periodic compounding becomes a one-year result. APR describes regulated borrowing cost. APY and AER describe savings yield under prescribed rules. Nominal versus real tells us whether inflation has been removed. Next, we move from rates to data summaries, mean, median, and weighted average, and why one unusually large value can completely change the story.